Hi, welcome back. Rupee and rupee depreciation is what everyone around is talking about. RBI is actually putting in a lot of efforts to curtail the drop of rupee, and yet one more measure introduced by RBI to kind of curtail the drop of rupee is something to do with cash management bills. Our entire video is going to focus on the origination of cash management bills, how are they used, and its impact on the financial markets, and how is RBI trying to curtail the drop in rupee using the cash management bills. Okay, let's try and first understand a little background. Till March 1997, what happened is the central government was expected to keep 50 crore rupees with RBI on every Friday and was expected to maintain a balance of 4 crore rupees with the RBI on a daily basis. Now, this balance of 50 crore rupees and 4 crore rupees, which was expected to maintain by the central government with RBI, was to make sure that if there is any emergency to do with our fiscal deficit, this fund will be used. Okay. Now, typically, what happened is always the expectation was not met, and let's say Friday RBI was expecting 50 crore rupees of balance from the central government, but only 40 crore rupees was maintained, and there was a deficit of 10 crore rupees in this fiscal deficit fund account. Now, how would the country make sure that the fiscal deficit account had 50 crore rupees when there was only 40 crore rupees put by the central government? This would be done by infusing 10 crore rupees from somewhere. Now, who would give this 10 crore rupees? So, what happened is RBI used to self fund this remaining balance of 10 crore rupees. So, what would RBI do? RBI will issue a treasury bill to itself for the remaining amount, which is 10 crore rupees, and that 10 crore rupees was put into this account to kind of maintain the balance. Okay. Now, what happened is this method of RBI issuing treasury bills to itself to maintain the fiscal deficit account, okay, was called the Ad Hoc Treasury Bill. Now, Ad Hoc Treasury Bills were typically 91-day instruments, okay. But what kept happening is over a period of time when our fiscal deficit kept increasing and hence this gap kept widening, ad hoc treasury bill measure was not possible is because ultimately all the money that the central bank was trying to use was more to do with maintaining the monetary policy. Okay, but what was happening is because of the fiscal deficit increasing, they were not able to use that money for monetary policy, but they were all getting involved in the ad hoc treasury bill issuance, and hence in April 1997, okay, this ad hoc treasury bill was scrapped. Because ad hoc treasury bill was scrapped, it actually had to be replaced by something, and hence there was something new which was introduced in the market, which was called ways and means advances. We will call this WMA now. Okay, so now if the government wanted to be funded for the fiscal deficit emergency, okay, it would be funded by something called as ways and means advances. Now, how would ways and means advances work? What happened is at the beginning of the year, which is April, okay, the RBI would declare saying how much money are they willing to give to the central government for the next 6 months. So April to September is the first 6 months. So RBI will announce in the beginning of the April itself how much are they willing to give to the central government under the WMA. Currently, it is 30,000 crore rupees that the RBI gives to the central government under the WMA. At the end of September, they will again announce that for the remaining 6 months, which is September to March, how much will they be willing to give the central government. So that's how the WMA offers at this point in time. Now, the point that you have to understand and remember over here is this 30,000 crore rupees that the RBI gives to the central government under WMA. On this, the central government has to pay the interest rate, which is the current repo rate. Because the central government is borrowing from RBI, the borrowing does not happen free of cost. So the central government pays whatever the repo rate is to RBI. Okay, so currently it pays 7.25% under the WMA borrowing that it does. Now, the point that we have to understand out here is, let's say for the first 6 months, 30,000 crore rupees is what the RBI is willing to give the central government under the WMA. As soon as 75%, which is 22,500 crore, as soon as 75% of the amount which was to be given to the central government under WMA is funded, which means 22,500 crore when is given, the remaining 25% of the WMA which is supposed to be given by RBI to the central government will not be funded by RBI, which means this 22,500 crore, which was 75%, was RBI giving its own money to the central government. But the remaining 25% is where RBI will not give to the central government, but they'll use a different technique which is called the cash management bill. Now what happens in this case? Let's try and understand. The remaining 25%, what will RBI do is, RBI will issue cash management bills like treasury bills, cash management bill. There is no difference except for few which we will discuss ahead. So RBI will announce in the market that they are willing to raise up to, let's say, 7,500 crore rupees. Okay. Financial institutions like mutual funds, commercial banks, and all will give this 7,500 crore rupees to RBI. RBI will issue a promissory note to them saying, I will return your 7,500 crore rupees with interest. Okay. That promissory note is called the cash management bill. Okay. Now, the 7,500 crore rupees, which is 25%, okay, is raised by RBI through financial institutions and commercial banks, and then it is given to the central government under ways and means advances. Okay. Now, why do you think RBI is actually going ahead and raising money from the market to give it to the central government under WMA? The logic is simple, because the more money RBI pumps to the central government is going to use this for the development of the Indian market, and hence whatever money the central government is receiving through RBI is indirectly pumped back to the market. Now, if more and more money is pumped into the market, that is going to create inflation, which is another problem that India is facing. So what RBI does is simple. RBI removes money from the market only through cash management bill, gives it to the central government, and the central government pumps it back into the market. This helps reducing inflation rather than RBI printing more money and giving it to the central government, which is pumped into the market, which increases the money supply in the market. Hence, the remaining 25% is funded by something called as cash management bill. Now, there is hardly any difference between cash management bill and treasury bills. They work exactly the same way, where RBI borrows money from financial institutions and commercial banks and issues a promissory note that I will pay you back your money with interest. Okay. Somewhere it is called treasury bill and somewhere it is called cash management bill. So what's the difference? The primary difference is that the cash management bills can be issued for a tenure anywhere between 7 days to 1 year. Okay. So you can issue a 23-day paper, you can issue a 34-day paper, you can issue a 35-day cash management bill. But a treasury bill can only be for 30 days, 91 days, 182 days, and 364 days. That's the prime difference between a cash management bill and a treasury bill, which is the tenure for which it is issued. I hope it's clear so far. Now what happens is, what you have to understand is, why is the cash management bill technique used currently by RBI? Okay, let me throw some light on that now. Why is the cash management bill technique currently used? Now all of us know that RBI wants to reduce the rupee supply in the market because the rupee has been depreciating. So if the rupee availability in the market is reduced, probably rupee might appreciate. Okay, and hence the problem of it hovering around the 61 to a dollar, 61 to a dollar might come down. That's the expectation. Okay, so what is RBI going to do? RBI from this week onwards is going to issue 22,000 crore worth of cash management bills every week. Now how far are they going to issue, that they have not discussed so far, but 22,000 crore worth of cash management bill is to be issued every week. On Monday, which is the 12th of August, RBI is going to issue 35 days maturity worth of cash management bill for 11,000 crore, and on the 13th of August they are again going to issue for 34 days cash management bill for 11,000 crore. So every week they are going to raise 22,000 crore under cash management bill. For what tenure, what amount is what they will discuss a day before and announce it. Okay, now this is what they've lately introduced to the market. Now the important point is, why RBI is issuing cash management bills and not treasury bills. Now there are two reasons. I will discuss with you both the reasons. Now the important point to understand out here is, why is the RBI issuing cash management bills over treasury bills? Okay, there are two reasons to it. Let's focus on the first reason. The first reason is that as per the new debt norms, any security which is issued for a tenure of less than 60 days, the valuation of that particular security is done as per amortization rates and not mark to market. Now what does this mean? So say for example, there is a mutual fund who is investing in a security which matures in less than 60 days, which is the cash management bill issued for 34 and 35 days. When they've invested in this 35 day paper, they don't have to do mark to market, which means if interest rates move down, the security value will go up. We've learned in our past videos. Similarly, if interest rates are supposed to go up, which is the current threat that we are facing, the value of the cash management bill will drop. When the value of the cash management bill drops, it's a loss for the investor, and hence the investor has to, at the end of the day, pump in more money to manage the mark to market losses. This is what happens when the security is more than 60 days. But because any security which is less than 60 days works on amortization rate and they don't have to do mark to market, which means if I'm investing in a 34-day paper, the daily up and down of the security will not make me invest more money in mark to market, but I'll be more concerned of only the return that I'm going to get when I held on to the security for 34 days. So like a fixed deposit, when I invest in a 10% fixed deposit, I'm not bothered about the value of my fixed deposit in the interim. All I'm bothered about is the money that I make at maturity. So when any product or any debt issued for less than 60 days is to be valued at amortization rate, mark to market would not have to be done, and hence even if there are fluctuations in interest rates in the market, the daily losses will not have to be made good by a mutual fund, and the mutual fund will only have to focus on the interest that they get at maturity. This is going to reduce the volatility of the cash management bills in the market, hence one very big advantage. Why is it a very big advantage? Is because last 1 month you entirely saw the debt market going through a lot of trouble, is because when the interest rates were kind of moving higher and the currency was depreciating, you saw a lot of FIIs moving out of the debt market because they had to make the mark to market payments. That's where a lot of mutual funds faced a lot of redemption pressures. Okay, that is not going to be the case because this security is less than 60 days of maturity. Another important point we've got to understand is why cash management bills were issued over treasury bills is because, understand, the 34-day maturity and the 35-day maturity, which is to be issued on Monday and Tuesday, is going to roughly mature on the 17th of September. Okay. Now, what is the importance of 17th of September? In India, advance tax has to be paid by any entity which has more than 10,000 rupee worth of liability, tax liability. Hence, on the 15th of September, whatever tax liability is there, you pay 30% of that tax liability in 3 installments. So the first installment is that on the 15th of September you pay 30%. On the 15th of December you pay the remaining 30%. And on the 15th of March you pay the remaining advance tax of 40%, accounting to 100% tax paid. That's how it works in India, which means that all the banks will also have to pay on the 15th of September 30% of their advance tax. Okay, which means that if this security matures on the 17th of September, it will take care of the liquidity shortage that the bank has due to paying advance tax on the 15th of September. So on the 15th of September, advance tax will be paid by banks, hence they will be short of liquidity. And on the 17th of September, the cash management bills will mature, giving them the required liquidity. Hence, the liquidity situation in the market will also be taken care of. Plus, excess rupee will be sucked out from the market, which in turn is expected to reduce the volatility on the rupee, and the rupee is expected to appreciate. That's the entire logic of coming out with cash management bills and its impact on the market. I hope it is absolutely clear to all of you. Thanks for watching.